Okay, ladies and gentlemen, let's remember that the story of the world is competition for resources, how people deal with the concept of scarcity. Then remember, scarcity is limited resources to fulfill unlimited wants and needs. And the end goal, of course, is overall societal and individual happiness. And what we're trying to do in economics is study the choices that people make to try to get to this goal of happiness while dealing with scarcity. Now, in this section, we're dealing with this part, the limited resources part, because in economics, we need to know what those resources are and we know how to classify them. Then we can start figuring out how to make good choices in dealing with those resources. So in economics, we classify resources as land, labor, and capital. And the people that are best at putting those things together to create goods and services are entrepreneurs. So we have the idea of entrepreneurship. Let's start with economic factor number one. Now, again, factors of production are simply resources. All right. The three economic factors. Number one, land. Land is simply all natural resources. So, natural resources are going to be gifts from nature. Trees, now, understand the vines are going to be a natural resource. The vines will be land. The actual vineyard itself, that's not created by nature, that's created by people. An orchard is an orchard overall is going to be created by people. The land piece here is going to be the pear tree or the apple tree. Oil, petroleum, land. Oil platforms, not land. Um, a farm is not land, but of course, wheat is land. And of course, even sunlight would be considered land. So anything that are gifts of nature, those are natural resources. Property is another example of land. So the school itself, Ukiah High School up here in the corner, that is not land, but the property that Ukiah High School is on is land. All right. So land is any natural resource. Now, one thing we want to get down is being too reliant on any one natural resource is really, really rough on an economy. And so, any kind of country that gets most of its revenue from a single natural resource, that is known as a rentier state. And rentier states are usually it's oil that a country that is a rentier state gets its revenue from. So in this case, it's revenue from land and oil. Now, when we talk about rentier states in this class, the ones that are the primary ones we'll study are going to be Iran, Russia, and Nigeria. These three countries get most of the income of their country from land, in particular, petroleum. And this creates what's known as a resource curse. A resource curse means that you're basically at the will of a single piece of or single commodity, in this case, oil. Now, this what will happen, of course, is that other countries want to invest in your country because you have the resource they want. So places like the United States or China will invest in Iran, Russia, or Nigeria. Uh, and that is what foreign direct investment is, either by countries, states, or by multinational corporations, Exxon, Shell, that kind of thing. This, of course, creates corruption because it's opportunity. These states are usually weak. They're only getting their income from that oil. They know they have the oil, and so what will happen is immense amounts of corruption. All three of these countries are very, very corrupt. This will create massive amounts of environmental damage. Why? Because, of course, the resource oil um, it's difficult to pull out of the ground. It is difficult to transport. It's difficult to refine. Pipes break. Oil ships, tankers run aground. All kinds of things start to destroy the environment. So in rentier states, you're going to see significantly higher environmental damage. This leads to, of course, overall to political instability. You'll see things like coups, civil wars, those kinds of things. And countries that eventually become dependent on a single resource usually have economies that are unstable. That's why Nigeria, Russia, Iran, Mexico, less so more recently. In the past, much more, they were more reliant on petroleum. But countries that are, you don't want to just be dependent on a single resource. You want to diversify. You want to have a lot of different things going for you. So, fun fact: the United States is actually the largest importer and exporter of oil in the entire world. But of course, oil is not our only good or service that we provide. So we don't suffer from a resource curse. The second economic factor of production is physical capital. Physical capital is simply a good that is produced by people used to produce other goods. So, any kind of good, a hammer is used to make a house. So, a hammer would be considered physical capital. Shears for a barber, physical capital. An airplane to transport things, physical capital. Cranes, smartphones, factory warehouses, trucks, any good that is produced with the intent to make other goods or services would be considered physical capital. Now, the whole point of physical capital is to make things more productive. So, in this case, physical capital makes labor more productive. You start by counting with your fingers, then stones, then abacuses, and then you have different forms of calculators, and finally a smartphone. It makes people more productive. Used to have these, goofy looking washing machines. They got a little more productive, and then eventually you could just throw it in there, throw in some soap, and bam, in an hour your wash is done. Warehouse cart evolution. You went from people having to carry things around to having them on rollers to having them on more motorized crates to now you have robots in Amazon warehouses that are running things around. So physical capital actually makes labor more productive. It also makes land more productive. When you innovate, you actually make land do more for you for less. So overall, global agricultural production has gone up throughout modern history. But somewhere in the 90s, 2000s, all of a sudden the amount of land that you needed to feed the world started to drop. And so you had an increase in forests in places like North America, and people were still getting fed for the simple fact that the amount of land it actually took to feed a person went from 1.55 hectares per person, which is actually quite a lot of land, to next to nothing now. And why? Because capital has been innovated. You have things like GMOs allow for pests and blight not to destroy crops. You have better forms of irrigation that actually irrigate more land for less water. All these things are have come together to make physical capital more productive and or labor and land more productive through the use of physical capital. China would be an example of a country that is using technology to become more innovative, whether it's robotics, AI, better forms of transport, using drones to fight fires. This would be an example of making physical capital more innovative. However, of course, they have a competitor, that being the United States. Now, labor is the last economic factor of production. Labor are people engaging in work for which they are paid. You must be paid to be considered labor. Some people will look and say, well, are animals a form of labor? No, they are not being paid for their work. Is a AI or a robot a form of labor? No, that is capital. What about a slave? Well, if a slave is paid for their work, then they would be labor, but a slave is considered capital, which is why, slavery, inefficient, morally reprehensible, uh, labor must be paid. Now, labor, the whole point of labor is to use their human capital, which is human capital is the skills and knowledge of the workforce. It's all your talents and your training and your creativity and your health and your judgment, energy, wisdom, knowledge, all of that put together, that is human capital. That's what you're trying to do here at school is develop human capital. And the more human capital, skills and knowledge of the workforce, the more your income goes up, the more the economy becomes dynamic. This is why when we look at things like immigration has costs and benefits, but economically, whenever you see people come to a country, immigrants bring an economic positive. They increase demand for goods and services. Yes, they increase taxes because immigrants, whether they're here legally or not, do go out and buy things that increases sales tax bases. They take lesser desired jobs and even keep prices low. They're entrepreneurs. They come to this country and create jobs, which of course compounds things because entrepreneurs need people to work for them, which creates a raise in income of people around them. Of course, they bring different ideas, perspectives, they integrate cultures together better. They work harder than native populations and they are way less likely to commit crime. So when Immigrants come to the country and they bring in their human capital. It does nothing but create a net benefit overall for a country. Are there some problems? Of course, there are costs and benefits to every choice. Immigrants, definitely a net positive. Now, when you look at your AP6 countries plus the United States, what you'll notice that immigrations, there are net increases, there are net decreases, and then there's flat out something known as brain drain. Net increases in immigration, the UK and the United States clearly have net increases in immigration. Net decrease in immigration, China is starting to lose people as it's becoming more and more authoritarian yet again. Brain drain, people that are actively trying to leave a country because the conditions there are just bad. Russia, obviously, because of the Ukrainian war. Nigeria, the conditions they are in Nigerians are insanely entrepreneurial. They work insanely hard, but the conditions are not conducive to starting a business. And so a lot of Nigerians, over 55% of young Nigerians want to leave Nigeria. Iran's a repressive regime. A lot of Iranians are trying to get out of the country. They suffer from brain drain. Mexico has suffered a bit of brain drain, though it is starting as the economy continues to grow to go less. Now, what you're seeing brain drain from southern Mexico moving to a much more prosperous northern Mexico where you have a better chance of making higher income and making money. Then, of course, the people that put these all together are entrepreneurs. They combine the factors of production, they take a risk, they create a good or service, and they end up satisfying the wants and needs of the people in return for some kind of profit. Whether it's Musk, Beyonce, Oprah, Steve Jobs, Carnegie, Bezos, they all took land, labor, and capital. They took a risk and they produced goods and services that society wanted, therefore helping alleviate some forms of scarcity.